All right, thanks guys for joining me. It's been a while since I've done a podcast, so this is a little bit of a new format that we're going to try out. But I want to welcome you guys, Parker Lewis, of course, now of Zap, right, and Tuur Demeester, who is Adamant Capital still.
Adamant Research. Yes.
Adamant Research, yeah. So, you guys are obviously really well known in the space as being, knowledgeable about what's going on from a macroeconomic perspective and stuff. So that's kind of where I wanted to go. But thanks for being here, guys.
Yeah, it's good to be back, Jimmy. I think it's good to have you back in Austin, have you back recording a podcast, getting a book out, and very glad to be here with Tuur and being able to welcome you back to the podcasting world too, because you had a pretty long hiatus there.
Yeah. Appreciate that.
Same, as excited as I am to keep hearing about your world travels.
Yeah, we'll have to do something about that at some other point. But today I want to talk about macro and what is going on. So I'll sort of throw this question out to you guys and see where it goes. But what's your interpretation of what the Fed has done over the past year? Because obviously rates have tightened significantly, right? Like it's gone from, I don't know, it was almost 0% to what's it now, 5 something. Mortgage rates are, I think, 30-year mortgage is like hitting like 8% range, something like that. What are they thinking? What are they doing, and why are they doing it?
Want to take that?
Why don't you go first?
Sure. I mean, I don't know about exactly the past year, but I just feel like they're stuck. They, I think they want to ease because they're sensing that. I mean, obviously they're sensing that banks are in trouble. Even Charles Schwab is in trouble. Like, it's a disaster. I think the narrative has kind of disappeared from the newspaper headlines that all these banks are in trouble. But, and so with the rates being this high, that's not going to change. There's just so many institutions across the board who, I compare it with the oxygen, right? I mean, you just, as you raise the interest rates, you turn down the oxygen, and who's going to choke and die first? It's the entities that have the highest debt, and the entities with the shortest duration debt. And, U.S. government is one of them. So they know they have to ease. The question is just when and how can they do it while saving face? And so it'd be convenient if there was some kind of a market downturn that they could point at as a reason, why. They are touting, everyone seems to be touting that inflation is going down. I've been listening to public radio, and they keep putting out this word disinflation. They just love that, like disinflate, because it sounds good and it's kind of sounds like the opposite of inflation. But all it is like the inflation is slowing, the growth of the inflation is slowing down. So it's kind of saying like, well, the cancer is not in remission, but it's not growing as fast anymore. It's like, so anyway, like that's kind of my general take, is that they are going to lower it eventually. I think that we are close to the max that they could ever do, like maybe some cosmetic increases from here, but I don't think they can be aggressive anymore because, we're already paying the government is already up for, what is it now, $1 trillion just to pay the interest rate for the interest payments for a year. So I think that's about as far as things can go.
Yeah, I think Tuur brought up a really important point that I think it's the banks that because they've kind of faded to the background, but the series of bank failures that happened in March, that the problem that caused that has not gone away. It was directly related to the Fed raising interest rates very quickly. And if the Fed was reacting to inflation increasing, really started to accelerate in the fall of 2021. And then they started raising interest rates in 2022. And then they really accelerated things as their own metric of reported inflation, which lags real inflation, started to get out of control. Well, their rapid increase of interest rates created the essential run on the banks, the weakest banks, and it always will. And that while that happened in March and kind of people have turned the TV off on that episode, the underlying issues that cause that, in my view, are still there and they will reappear. And that's why the Fed can't do a lot more. They are in this kind of catch-22 where the banking system is incredibly fragile at the same time where the raising of interest rates, like they might be able to reduce asset prices, but gas at the gas station is not getting cheaper and food at the grocery store is not getting cheaper. And what you notice, the connection is that anything that has to be produced with human time has not gotten cheaper. It's getting more expensive. Things that already existed, real assets in the past, they can control those prices because they're supported by a lot of leverage. And so basically, it's not really even a game of chicken. It's just that they're walking into a buzzsaw and you don't know exactly when they're going to hit the buzzsaw, but it's inevitable that they will, just like they did in September of 2019, which set off the most recent money printing epic. So it's kind of one of those things where it's like they've started to psyop people into this idea of a soft landing or disinflation, or Krugman's come out and said, no, I think the long-term inflation should now be 3%. Out of the blue, just made up a new number. Like, why not 4, Paul? Why not 5%? And that everything ties back to, you can pull on a thread, but once you break it, you can't push it back in. And so they're still pulling on it, and they think that they have, more control that they do, but it's just inevitable that something, without being able to predict exactly what breaks. And I like to reinforce for people that in 2017, when they started to unwind post-financial crisis QE, it took about 2 years to hit that buzzsaw. But that also during Bear Stearns happened in March of 2008. Lehman happened 6 months later in September of 2008. The repo markets broke in September of 2019. The crisis really wasn't felt until March of 2020. The banks failed in March. It's like, I think everyone expects that first crack in the facade to ultimately be the ultimate crisis. And to think that it's gone away, it's just bubbling under the surface. And that each moment, each day that this over leveraged world exists with higher interest rates, more and more is getting broken. And you just kind of got to try to get as far away or insulate yourself from the blast radius, knowing that you're not going to be able to totally be
right.
Immune from whatever happens.
Yeah, it's like with that submarine story where they heard cracking every time they went down, and they just kind of justified it as like, oh, it's just the material is just setting. It's like, no, what probably happened is that they were cracks and they got worse and worse and worse over time. And that's kind of how I feel about how things are now. It's like, yeah, we saw the first cracks, and those are still there, not going away, and people are now responding to that, and like Evergrande just went bust. Like, that's a huge real estate company out of China, and like, who knows what's next? Like, Schwab is in the news.
Are they
now.
Also a shipping company? Isn't that, it wasn't Evergrande the
Evergreen, I think.
Okay.
Yeah. Evergrande is the real estate developer.
Yeah, it's this enormous real estate company that finally defaulted on their I think bond payments. But so yeah, I agree, and I agree. It's good that you brought up that 2019 episode, because people like to think like, oh, there were bailouts because and stimulus because of COVID. It's like, no. COVID was awfully convenient from a government bailout point of view, because the problems were already there. Like, markets were like you said, from between 2017 and 19, they're starting to tighten, and the buzzsaw was coming regardless of this global pandemic.
Yeah, that is one thing too that I think people easily forget. That the repo market, and just kind of provide the context, the Fed tried to reverse out before, right? They had, so we'll like fast forward or rewind on history. They introduced $3.6 trillion into the financial system from 2008 to 2014. Then in 2017 tried to withdraw that money, that they had increased the money supply by 5 times. And then September of 2017, they started to take that money out, the 3.6 trillion. The repo markets, which is a large overnight funding market, had an interest rate of 3% one day, and then the next day it was 10%. And the next day, the Fed came in and put $75 billion into the market. And like, 75 billion is a number that really we can't conceive of what it means. But that happened in a day. And at the height of the post-financial crisis QE, they were putting 85 billion in a month. And so everyone associates the money printing with COVID and the lockdown. And it was like, hey, they had to print this money, but the imbalances were massive at that time before COVID was even an inkling on anybody other than maybe the World Economic Forum's radar. Planning their gaming, that they had in the fall of 2019 around like a pandemic. But so that happened in September. And then the oil war between Russia and Saudis was in February. So there was this massive imbalance in the oil market too. That was before anyone had ever heard the word COVID. And then the COVID lockdown happens and everyone associates the money printing with that. But we had these two massive markers of, as the Fed was trying to unwind the money printing in a massively leveraged system, they walked into a buzzsaw, and the exact same thing is happening now. Like basically in my world, the marker of the last kind of beginning of the crisis, which was the repo markets, was those bank failures. People weren't really looking at the banks, and then boom, it's never going to be the same thing twice, because the Fed's going to be paying attention to those markets a lot more closely, that it's going to be something else that breaks, and then they're always reactionary and will ultimately result in them printing money.
So what do we think the next cover story is going to be? Because they always need some spin as to explain why.
Well, let's back up a little bit, because what you guys said, I think, is going to be a shock to a lot of people, because what you're saying is the money printing didn't happen because of COVID. It happened because of some systemic deleveraging or something that was happening prior to that, from 2017 to 2019. And essentially, they used COVID as an excuse to bail all of those things out. So tell me the mechanics of that. What did they do to, I don't know, how did the repo market, I guess, get fixed as a result of COVID and so on?
Parker, take it away.
Yeah, what they effectively do is, and they will call it different things, but they will click a button on a computer screen and put money in somebody's account that wasn't previously there, so that entity now has money to fund loans in the repo market, to simplify it. Basically, everyone had pulled back from that market, so the borrowers that needed the money to be able to fund overnight transactions, which is a big part of what the repo market helps fund, the lenders in that market stepped away as dollars got more and more scarce, as liquidity got tighter and tighter. So what does the Fed do? The Fed basically says, and in this case, what they actually did was they basically said, we'll step in and lend or buy repo, basically like loans that were on repo, to basically inject liquidity in to that specific market. Then fast forward into March when quote the COVID crisis happened, but it was really just this kind of reverberation of these massive imbalances that existed in the markets as the Fed tried to unwind QE. Was they started a formal QE program, and what they do there is they just either Powell, I think Bernanke, it's Powell or Bernanke, one of them said carte blanche, how do you create money? It's well, we just click a button on the computer screen and we credit the person's account with more money. They've said that literal thing. This is not me paraphrasing. It's he literally says, we click a button on the computer and the account shows more money, and there it is.
I think that's the one where they also said we have an infinite amount of cash available.
Yeah. They say these things out loud. And so what they did in March of 2020, which they'll do again, is they clicked the button on the computer screen and bought the bond. So it's people are selling credit because there's a liquidity crisis and there's not enough money to go around to service the debt. The way to reverse that is Fed clicks a button, creates new dollars out of thin air. They use those dollars to purchase the loans that nobody else will buy and that's what stabilizes interest rates.
Yeah, and if I remember right, they also bought up huge amounts of mortgages, which are also loans, and propped up real estate markets. And so, in a big way, I think they were responsible for the real estate craze of 2021. What happened there is just, and that's going to be for the history books. That was a mania.
Yeah, crazy mania. Just housing prices doubled, and then now they look like they're about to crash. But going back to this, because I really want to make sure that we get this right, because I don't think this is a narrative that most people have heard. including myself, like my thought was, okay, here was COVID, here was an emergency. Everybody was shutting down. So, in order to help all of these people that were gone for 3 months from their business, you inject liquidity to help those people, particularly around people's employment. So, you got PPP loans based on how many people based on whether you kept people in your company and so on. Like that's the narrative that I think most people are familiar with. What you guys are saying seems rather different.
Well, I think they did both. What I was explaining was that the root cause of the crisis that induced all the money printing was actually the credit market seizing. And if you go back and look at it, they did do these, PPP loans, but they also created programs to buy corporate debt.
They did, yeah.
Municipal debt, mortgages, more treasuries, that in general, it's like they're all related. So if people stop going to work and they stop paying their bills, like imagine what was happening was like there was a rent moratorium. Well, imagine somebody who owned a commercial piece of real estate and they had a piece of debt on it. And then the person who's renting stops paying and then they can't pay their debt. And then that credit market collapse, So like all these things are related, but the idea that the $5 trillion that was created out of thin air had to do with a pandemic, no, it had to do with the pandemic in a world where there was a massively leveraged financial system and that financial system was collapsing. And if you want to save the quote economy in their eyes, because the financial sector is at the center, everything has to go through the financial sector in the Fed's economy. And the only way to resolve that is to create a lot more money. Otherwise, the whole credit system collapses, and then you're not even going to have businesses to have people to go back to. So it wasn't necessarily an either or, but at the root cause, in my view, it was look at the repo markets, and they had put $500 billion into the system in 6 months, which was faster than they ever put money in the system before. And that was before there was a government lockdown.
Yeah, like a simple way that I look at it is just to look at this economy as, a person who's hopelessly addicted to credit, right? A cheap credit, and has like organized their whole life around that, like hand-to-mouth living, just assuming there'll always be a next loan around the corner. And so what was happening with, of course, there's always some external shock, like that's just life, it's just the way the world works, there's always going to be something unexpected. And so when that pandemic came around, what the economy wanted to do was go into withdrawals, right? It's basically saying like, I can't pay the debt, I gotta, there was so many businesses who actually, like I remember the Cheesecake Factory here in Austin, like that was a company that was supposed to go bankrupt, and because they literally stopped paying their mortgage, their rent and stuff like that to the malls that they were in. But they got their PPP loan, this and that, like they were rescued. And so this kind of hopelessly addicted economy can keep using, and it was never allowed to actually restructure and go through all that creative destruction where a lot of consumer focused companies would go bankrupt, and slowly we'd see a shift happen towards more basic services, which is ultimately people are going to have to do that. Like you can't keep buying digital widgets if literally everybody is in debt on a net basis. Like, you got to go back to the basics. And eventually it'll happen. But in a way, the Fed and the government, they're trying to, avoid the inevitable.
Yeah. And I think that one of the important things there was that people often look at the COVID lockdown or the government lockdown. But the point that Tuur makes is that like, an exogenous shock was inevitable. So everyone like that's what grabs people's attention. But the idea is if you have this extremely fragile system and it's fragile because of the high degrees of leverage that do not go away, that whether it was the COVID crisis, it would have been something else. Like basically an exogenous shock is inevitable because of the fragility. And, like it is, like if there was a setup for oil to go negative, which there was, that started before the economic system was shut. right? And so then the question is, well, what created those massive imbalances? And kind of like building a very fragile home on the coast, right in a hurricane pattern. Maybe there isn't one this year, but there's going to be one, and that house is getting knocked down when it comes to it.
You bring up a good point. Let's talk about the oil for a second, because that's something I feel like I still don't understand. How do you get a negative thing? And I mean, the narrative that I have from the mainstream is no one was going anywhere, so oil wasn't being used, so it crashed in price, and they produced too much, and there was nowhere to put it, and therefore it went negative. That's what I've been hearing. It sounds like you guys maybe have a different interpretation of what happened.
No, what I'm saying is that if you go back to like what happened in time sequence leading up to the COVID lockdown and crisis, that everyone assesses as the marker for why they printed money. That it started with the repo market breaking in September of 2019. The Fed started re-injecting money then. Then if you Google articles in February of 2020, so like at least in the United States, COVID did not start to become like people started to be aware of it maybe in February, but like there was no lockdown. So there was no economic activity that stopped because of it until mid-March. That you can find the articles where it's like the Saudis and the Russians do not agree to cut output in February. And that starts to cause the price of oil to come down. So there was something technical in this I'm not incredibly conversant around of like why oil actually went negative in terms of like the storage space, and like there were people who were speculating on it that couldn't actually take delivery. So this was a crazy market anomaly. The more fundamental signal though that I'm just trying to make is that this imbalance that caused like oil to go from say 80 to 50 in a 1 month period was because there had been this massive imbalance where there was not demand and the supply exceeded it significantly. And all of that was before COVID. And there's massive economic consequences to a market as big as the oil market going from 80 to 50, where it might've been like 80 to 40. That was the fundamental move. The more technical one was one because of financial speculation, in my opinion.
Yeah. And it reminds me of something that you often see in markets when you look at charts like medium or long-term charts. Oftentimes you'll see something happening, like some kind of resistance level, support level gets broken, and you just feel like, oh, something shifted here, just from a price technical point of view, and then later you see headlines talking about, for example, with Bitcoin, like the price went down, and they print headlines that try to explain what happened. Whereas oftentimes it's as boring as too many people went long leverage and they needed to be flushed out. And then whatever the little gust of wind is that makes your margin call be activated, then that's going to be the big headline. If that's in the best case. Often I feel like they just make stuff up like, So I feel like that's what Parker is also talking about, is like you have these setups, just like, when a forest, maybe that I don't know for sure by any stretch of the imagination, but one example would be, hypothetically, there's an island where there's a lot of on one side of the island there are a lot of like buildings with very dry materials, and there's like a certain wind that goes in a certain direction for a long time, and there haven't been forest fires in 50 years, and then all of a sudden there is a fire. Well, the explanation is like it was baked into the cake, like it was bound to happen at some point. And it's not something that just, it's not an act of God that we all have to be angry at. It's just something unfortunate that was likely bound to happen.
Yeah, well, it's kind of like the title of your book, Gradually Then Suddenly. It's been building up for a very long time, and then it just sort of, you don't know what triggers it, but what you guys are saying is it was inevitable.
Yeah, and like there's a difference between saying that some shock to the system is inevitable, as well as recognizing that because the system is as fragile as it is, that the shocks to the system cause much larger fallouts than would otherwise happen if not for this manufactured world of high leverage where nobody has savings. And to Tuur's point, in total, everyone's in debt far more than could be possible if money couldn't be printed out of thin air, if this thing called the Fed didn't exist. So it's like, not to confuse the fact that, yes, even on a Bitcoin standard or a world of sound money, there are going to be exogenous shocks. The only question is, does society as you know it collapse because there's a storm, or do you just live in an environment where there's a lot more redundancy, a lot more stability, a lot more strength and resilience, such that when the storm comes, you kind of take a hit and keep moving forward. In the Fed's world, it's like there's always going to be exogenous shocks, but the problem is the fragility created by the leverage wouldn't exist if not for the function of a central bank creating money and having created the dynamics where the leverage could exist in the way that it does in a very unnatural way.
Yeah, and you can find historic examples like compare the crash of 1929 with the one of 1907. Nobody talks about that anymore, the panic of 1907, but they were the same events, but in one case, 29, there was a lot more leverage in the system, and you had a government who thought that they could be the knight in shining armor and try to rescue everyone, and they just made a 10-year depression out of it, right? And whereas 1907 was quickly forgotten because it was just a little bit of extra leverage that was washed out of the system. Some companies went bankrupt, and that was it.
So it takes years to sort of build up that leverage. It takes years to deleverage, in other words, something like that.
I don't think it would need to take years, but...
Yeah, the way I would describe what the Fed did was it created excess leverage over decades. And then it got to a point where there was so much leverage in the system that when an exogenous shock would happen, they couldn't just go back to the same playbook they did the 10 times before to provide a little bit of money, that basically had gotten extended in this state that was so far detached from normalcy or anything that could be understood as rational in terms of the amount of leverage, that, it's just, a domino was going to be set off. They were pursuing the same policy of every time there was a hiccup in the economy from 1980 on, provide a little bit of money. So rather than the system being able to, like Tuur was describing in 1907, rather than the overall economy being able to restructure and deleverage, it was give a little bit of money, prevent the deleveraging. Like, let's keep moving forward. The next time it would happen, okay, provide a little bit more money. And then you get further and further away from the point of normalcy or sustainability or stability. And, then 2008 happens and you don't know where the bottom is, or you don't know where the equilibrium is because you've gotten so far away from anything that could be considered a normal state of leverage.
Yeah, because you had a patient with a sore throat and you've been prescribing heroin for that.
Yeah.
Heroin.
Now all of a sudden he's going into withdrawals. I'm like, oh my God, we got to save him. Like, but we've never administered a dose this high. And it's like, well, let's try it anyway.
Well, he's gonna die if we don't.
Yeah, right.
Well, so right now we're sort of in a deleveraging environment, right? The high interest rates naturally mean that there's monetary contraction. And we're seeing sort of weird behaviors in the market. We have an inverted yield curve right now, right, where long-term interest rates are lower than the short-term. What's going on? Why is this happening? And how is this indicative of like sort of the reality that you guys are talking about?
You want to take this one?
Sure. I mean, at least the inverted yield curve, I think, is very rational. It just means that, ultimately, if you buy a bond, you're lending money to the government or whoever the issuer of the bond is, usually the government. So if you buy a 10-year bond, basically, you're trusting the government to pay you back over a series of 10 years. And what you take into account is not only like, well, are they going to be able to pay me back, but also what is the value of that money going to be in the future, right? If they pay me in year 8, year 9, year 10, what is the actual value of that going to be? And so it's much easier to predict or have some kind of confidence that whatever debt gets paid back within a year, which is a 1-year bond, is going to be, worth more. And also and also, of course, what you take into account is what all the other actors in the market might be thinking. And so if you think that, because there are existing holders of long-term bonds who might be selling, right? And if they sell into the market, they can push up the interest rates on those long-dated bonds further, and then the value of your existing bonds goes down quite a bit. So whenever you see rising interest rates of bonds, think bond crash. Like that's what's happening. So yeah, I don't know if Parker has a different take, but that's how I've been reading that so far.
Yeah, I think from a technical perspective, I agree with everything Tuur said. I think the maybe thing I would add is all those interest rates that exist. Yeah, and I don't know exactly where it is, if like the 2 years at 4.5% and the 10 years at 4%, but they're all manipulated, right? They're like to a certain extent, anybody that's in either of those markets is buying with the expectation that the Fed's coming back in to buy their bonds to force the asset prices up and the rates down. And that, it is a market anomaly if it were a free market to say, like, in general, if you're going to lend someone your money for a longer period of time, you would expect to receive a higher rate of interest or to forego your own consumption. But in the Fed's world, because they control interest rates by the supply of money, the more consequential fundamental is, imagine lending money to somebody. Like, think about buying $100,000 worth of treasuries, and they're 10 years, and you're going to get 4% back a year. That, what if the dollar lost 90% of its value against Bitcoin? What was your yield?
Very little.
And yeah, so the market is existing on either side, whether it's the short end of the treasury curve or the long end of the treasury curve, in this manipulated dollar state of there being, quote, a lender of last resort that is not capitalized, that just makes money out of thin air, as the world's figuring out there's a form of money that can't be printed. And so, like, the opportunity cost of, like, hey, I'm going to take 4% on a 10-year note in terms of a treasury, but, like, I don't actually get the principal back on that for 10 years, and a lot of bad things can happen. And dollar inflation is what it is, but ultimately what becomes the standard of value is Bitcoin. So it becomes, well, if I can't get that money back for 10 years, how much Bitcoin do I forego, or how much does the dollar lose in value between now and then until I get my principal back? Now, you can ultimately go into the free market and sell your treasury, but you better do that before everybody else figures out the equation.
Well, so all of your arguments are basically then that long-term more risk. So shouldn't the interest rate then be higher on the long end instead of that?
I mean, that is what people expect, and that's why people talk about this being an inverted yield curve. What I'm saying is that would be in a free market. This is not a free market.
I see.
Because they expect the Fed to come in, which the Fed will come in to buy these bonds, and the actual asset price of the 10-year will come down or go up more to bring in. It has to basically go up more to bring interest rates down more, because it's amortized over 10 years rather than, say, 2 years. So, like, the fundamental answer is correct. Yes, the interest rate should be higher for a longer duration. If the Fed didn't exist and there wasn't this expectation in the market that they weren't going to come in and buy a bunch of bonds, likely we would see a different, or not likely, we'd see a different interest rate complex.
Yeah, I need to think about it more. Yeah, you're right what you're saying.
Well, so one thing that I've heard on this inverted yield curve thing is that the Treasury is the one that issues these treasuries, right? And what I've heard is that they're selling all of them short dated instead of long dated. So there isn't as much supply of the long dated, 30-year or 10-year or 20, 15-year or whatever treasuries on the market. So people would buy them at like a higher interest rate, but the supply is so low that, whatever demand there is, it's sort of like manipulated that way rather than
it's like these shit coins when they start off their initial ICO with a very small supply, they can, like, jack up the price. Is that what you were saying? Like,
something like that. On the long end, basically. Yeah.
But think about, I don't know what the actual dynamics are, but there's something like 30 trillion of government debt that whenever someone's saying, like, there's not a lot of supply, it's probably, in the 5 to 10 trillion range, and so it's like one, just noting that in terms of like the relativity of like there's massive amounts of long dated U.S. Treasury, like in quantities that the human brain cannot conceive of what they represent in human time, and that will never be repaid. Now, when the Fed's increasing interest rates, the borrower who's insolvent, as are the people that are lending, have an interest to borrow for shorter periods of time because the government's hoping I don't want to lock into 4% over 10 years if the Fed's going to reduce interest rates to 0 in 6 months. And so there is that expectation, right?
So they're selling more short term, so they don't have to pay as much interest.
Because with the expectation that interest rates are going to have to come down, and they'd rather not be locked into higher interest rates for longer periods of time. Right. And I would just, kind of throw out there that, think about somebody going bankrupt. That if your friend that's chronically behind on his bills came to you and said, "Hey, can you give me a loan for 10 years?" You'd be like, "Hey, how about 3 months? How about you pay me back in 3 months?" So it's like when you get in this, so there's a lot of things, but it is logical that the insolvent entity that has interest payments over $1 trillion would rather borrow for a short period of time if they expected interest rates to come down, so that they didn't lock in to higher interest rates over a long period of time.
Yeah, but if you owned long dated bonds and the Fed came in and was like, "We're slashing interest rates again," wouldn't you benefit to a greater extent than if you owned shorter dated bonds?
I'm talking about the Fed or the Treasury as the issuer.
Yeah, but I'm just thinking about like just from a rational investor point of view, like, is it possible that that's the play, of investors who do buy the long dated bonds, that they're like, well, I'm willing to kind of go along with the crazy in the sense that 4% on a 10-year bond is ridiculous, but I'm willing to go along with it because I think in the short term the Fed is going to come in, slash interest rates, and the effect on my bonds spiking up, like being more valuable, is going to be greater in the long dated bonds than in the short dated bonds.
Oh, so they're anticipating rate cuts, and that would cause the interest rate cut would cause the bond price to go higher.
I'm like trying to think this through in real time, so I don't know if that's the case. I'm just
and
wondering.
I'm also assuming that what you're saying is correct, but that generally, if you expected your interest rate to go down, that you wouldn't want to borrow as a borrower at a longer duration. You'd rather pay the higher rate for a shorter period of time, and then when interest rates are down, then refi at a lower rate, essentially.
Yeah. The government is giving them themselves that option.
I ultimately think it's like, it's all noise. The United States government has $30 trillion in debt. It's never getting paid back. The only way it gets paid back is to print more money. Like the government themselves, like if not another dollar was printed, the U.S. government gets exposed as the most insolvent entity that exists.
Yeah, and if you align your investments based on the hypothesis that the government is going to keep printing money, you are aligned with the interests of the government, because it's not in their interest to default. Just like what we saw with Argentina, like usually what happened in 2001 was like an extreme anomaly. Like usually they just keep printing until they hit a wall, and the wall means kind of hyperinflation. So I just feel emboldened that like, yes, we can have some scare scenarios where temporarily like, ooh, is there going to be a market correction, or like our assets going to go down? It's like, basically like, yeah, you're speculating on a dollar rally. It's like, okay, but it might not happen. Like we might just be flat on the dollar, or we could have a decoupling where certain assets are going to go down indeed, and others are going to just rally through the roof. Like that's stagflation. Like that's that confusing concept of the 1970s where the best investments were gold, short dated bonds, and I think maybe utilities or something like, and then all the rest went down.
I think they had an inverted yield curve somewhere around there too.
Yeah, I believe so. Yeah, like long dated bonds were terrible in the 70s and short dated bonds did great. So it is that weird period again. Like I believe at least that this is stagflation.
People are anticipating rate cuts.
I mean, look, I think that it's kind of, it's hard to look at the past because we're in this like territory where the world has never been, you know, both the degree of insolvency of all these sovereigns at the same time that a new form of money is emerging that provides a viable alternative that didn't exist in the 70s. We were in the process of diverting away from sound money, not on the precipice of adopting, you know, kind of, or going the other way. And that I think in the simplistic Keynesian academic Paul Krugman, Janet Yellen, Stephanie Kelton worldview, it's I raise interest rates to reduce inflation. Like that's what they're trying to do. But I have this kind of like mental framework of high interest rates do not make oil more abundant or food more abundant. And oil and food are the two goods that require everything else to be produced. And so while the Keynesian academics look at the economy as, well, if I destroy demand for oil and there's all this supply, it's going to make the price of oil less, which then it's going to bring everything down. Well, what happens in reality is like everything that is an in-place asset, like a home, a car, or something that has a piece of debt on it, even an asset price like a company, they can cause the prices of real estate to come down because they're supported by the values are supported by this highly leveraged system. But the second they start destroying demand for oil, supply of oil gets destroyed. Basically, as a marginal barrel of demand comes offline, the highest cost producer can no longer supply the barrel of oil. So it's actually supply and demand come down together, and then there is ultimate scarcity. There's less absolute volume of things like oil, gas, power, food, the things you need to produce with human time on a marginal basis, but there's still an outsized number of dollars as those goods become more scarce, which causes two things to happen at once. And I don't know if this is technically what stagflation is, but it's like in-place assets are deflating because they're tied to the leverage system. But the goods that are produced on a recurring basis that need to be delivered just in time, where there's not a ton of inventory, they become more expensive. So like right now, we're seeing the value of real estate come down at the same time we're selling the price of gasoline at the pump go up and food not get any less expensive. And the food and the gas have to be produced and delivered because one's perishable, one has a supply chain that needs to have the pump constantly going. The value of real estate is not the same. So that, I think we're seeing these two things diverge, and for very logical reasons. If you pay attention, for, you know, one thing has to be produced tomorrow to be delivered, that thing's getting more expensive. Something's already been produced and has a massive amount of debt on it, and there's fewer dollars circulating. So the price of that thing that already exists is going down.
Yeah, that's my understanding of it. I mean, I'm definitely not an expert on stagflation, but roughly speaking, it's like the stuff that you want goes down in price or is flat, and the stuff that you need is going up, right? And so the basics is going, and so basically it means a stagnating economy combined with inflation. Yeah.
It seems like the reverse of when they print money, right? When they add money into the economy, it's these hard assets that tend to go up in price, like real estate, and, you know, stock prices and things like that. But when there's monetary contraction, the reverse happens, where it's the necessary goods that go up in price and the asset prices that come down.
Right. And I think it's very logical. It's like they put money in the system. The assets that already exist have more dollars competing for
it. Yeah.
Roughly the same amount of assets. The reverse is true. You take the dollars out of the system, same amount of assets, fewer dollars, but those in-place assets are also competing with the things that you actually need to be produced on a marginal basis. So it is very like logical. And then the way that I would describe it is, imagine you buy a house for $500,000 and you have a mortgage for $400,000. But then imagine that $500,000 house is only worth $350,000 because they've been taking the money out of the system. You default on your mortgage, but then also the bank loses money, credit contracts. That actually causes there to be even less credit in the system, less money in the system, which creates,
Well, deleveraging is taking money out of the system.
Right. But it basically accelerates on itself because they put the money back in the system to force the asset prices up so that the debt levels can be sustained. Otherwise, there's this, it's not just a, steady unwind. It's basically a accelerating collapse because the asset prices are necessary to be able to support the debt levels. And as soon as everyone figures out that that's not the case anymore, everyone starts defaulting en masse. And so they put the money in the system, like the way I describe it, to force the asset prices up so that the asset prices can support the debt levels so they can start to issue more debt, because they can't issue more debt if the asset prices don't support the existing debt levels.
I think what you described to me sounded like, yes, that's business as usual from the Keynesian point of view. It's like, the market is sputtering. So we pump more money in the system. No, I'm not summarizing it well, but what I was trying to get at is that I think that politicians and economists have been very myopic in the sense that they see what's right in front of them, and what they see and want to see is consumer activity. They want consumption. They want people to book travels. They want them to build a porch. They want them to do all these activities because then they see, and it's convenient for them because they love to get more tax income, and the more consumer activity there is, the more stuff you can tax. But what they're not seeing, which is because they're myopic, is all that important activity of oil exploration, of developing mines to pull ore out of the ground, just building core infrastructure for these basic, food and commodities. And so what they've been doing over the years is every time there is a slump in the economy, they've been injecting money, right? And then we have the Cantillon effect, where they want to inject money where they think it's needed, and they're myopic, so they're always focused on consumption. So they will make it easy for people to get money to get a house, and they create the housing bubble, and then they want to stimulate technology and the creation of Web 2.0 companies, and so then you get Silicon Valley and you get that big tech bubble, and I think what's happened is just we're reaching a point where there's almost like a lake of liquidity that's been created in the area where all the consumption happens, and there's a depression. There's too little water in the whole commodity sector. Like if you look at the commodity index compared to where stocks are, we had a bear market for a long time in commodities. Like there's not been enough exploration. Like there's not been enough production of all these basic commodities. And so we're going to see that even out. Like the Fed, that's the pushing on the string. Like they cannot stop that happening. Like there's going to be a rebalancing. And unfortunately, in their efforts to keep this imbalance in existence, they're destroying the money, right? And so Bitcoin investment, like Bitcoiners and as the Bitcoin pool grows in value, I think are going to be putting their investment dollars eventually, and not right away, but eventually to work in some of these basic sectors. And I don't think Bitcoiners and hard money savers are going to be investing in the next Amazon or something. I think it's going to be much more about maybe buying property and developing just the more basic parts of the economy. I mean, in a way, we're going to be rescuing them or revitalizing them.
Yeah, or figuring out what is really of value, like what people have to have. Things like pipelines and telecom.
Right.
And,
data centers, I do think, are going to be part of that core infrastructure and things like that.
Yeah, there's a distinction that I think Keynesian economists don't make, which is, for them, all spending is just spending, right? It doesn't matter if it's a consumer good or a capital good or anything else. For them, if you spend money, that's great because that's part of the PQ equals whatever equation,
Yes.
the ridiculous, the amount of rain that falls on the ground is the amount of rain that came down or something. But in a sense, that whole narrative is what, that mentality is what caused this sort of crisis we're in, is I think what you guys are saying is
like allowing bean counters to print money gets you into a really bad situation. I think that where we're at today.
That should be the quote to promote this podcast episode.
Don't let bean counters print money. Yeah.
That when you have these very academic people thinking that they can just turn dials on these incredibly complex systems with incredibly consequential things like money, that there's a part of it that's like naivety, but then there's another part of it that's kind of like trying to be godlike, of like
arrogance, maybe.
Arrogance. I can control things. Like I have better data, and if I just turn this one thing over here, but you don't realize that it's caused a knock-on effect in places that you don't see until several years later, or that you couldn't see because they have not just unintended consequences, but impossible to know consequences. And so, I think that each time we go through one of these cycles on the kind of legacy financial system, is that the system actually gets more fragile and more precarious. And so I just looked at that analog of like where we're currently at is Fed walking toward buzzsaw. And they're on that part of the curve where they're going to walk into it. And I can't predict whether it's in a month or 3 months. We can look at history and kind of like the episodes of like 6 months later, it took 2 years, but you just know that that's inevitably coming and you have to prepare for that because it's going to create volatility and stability and survive all markets. But that it's inevitable and they will come back in and have to print a lot more money. And like Tuur said, it's like the currency is a release valve, or like they're doing it, all of this at the consequence of destroying the money.
Well, so I have a question for you guys, because we are talking about sort of the fragility of the dollar and how all kinds of things are breaking. You have, the Fed doing all kinds of stuff, the government just running up incredible amounts of debt. Yet at the same time, we're seeing the dollar strengthen. Right, we're seeing what the yen is at right now, like 145 to $1 or something like that. Just the dollar is doing pretty well, relatively speaking.
But like go ask anybody who's living in America that is paying for food and gas and seeing their bank account dwindle to zero where they can basically survive. So it's like if the dollar is versus real goods and services, which is what matters. If your money is losing its value to real goods and services, that money is failing.
I agree, but
I was saying all that means is that the other currency is doing worse. So like if you're the best of a bad lot, it doesn't make you good.
In the words of Chris Anthony, the dollar ain't shit.
It's still kind of crazy to me because, is the dollar still the best despite it?
Well, but consider that in an environment that's extremely volatile and unpredictable, there is value to liquidity, like optionality, and that's still what the dollar represents to a very large part of the world, is that optionality. Like on a month-to-month basis, like between here and 30 days from now, you can pretty much rest easy that the dollar is not going to go down by 20%. And meanwhile, you have all that optionality. And so if you're reshuffling, if you're repositioning yourself, maybe you're selling a house, whatever you're doing, a lot of those transactions are going to intersect with the dollar. And additionally, we're seeing currency pairs like, what is it now? The Australian dollar, the yen, like all these like traditionally relatively safe currencies are breaking down. They're in terrible, terrible shape. The euro, like, I'm afraid that the European banks are going to roll over next. The euro has been, and that's the problem. We've seen it in the world of, if you've been in Bitcoin, you had the privilege of seeing all these shit coins and seeing what happens when once the trust is a little bit lost, it tends to go down real fast.
like
right?
D&D right now.
Right. I mean, yeah. So that's kind of the scenario in the world at large with the fiat currencies. And so then the dollar is still the biggest elephant in the room. And so you kind of go with that for now. At least that's my take.
Yeah, I know. I mean, I agree with it. I think that, like, I think the most important thing is, though, that there is a psyop under, no, this is maybe not the most important thing, but it will speak to the most important thing. There's a psyop going around that, like, tries to send a signal like the dollar's not as bad as that. So, like, we're good, folks, like, calm down. And like what Tuur mentioned earlier, disinflation, like inflation's going down. And that's all a psyop, because anybody that is operating in the real world knows that inflation isn't going down. Like, if you live in a house and your real estate is going down in value, but you don't need to sell your house, but the things that you need to buy each day and at the grocery store are getting more expensive, inflation is not going down, right? But they are psyoping, like, hey, inflation's going down, everyone just chill, right? There was this funny, not funny because it's consequential, but like Jason Calacanis, who's one of these like most out of touch Silicon Valley technocrats, had like put a tweet out in early August that was like along the lines of like, all these people that are complaining about the dollar inflation don't know how good they have it. And it's like, one, tell that to somebody that is struggling to put food on their table or, like filling their gas tank up to get to work, because that's happening all over the country. But then like 2 weeks later, he tweeted, I was like, holy shit, I just went to the grocery store. Like, groceries are out of control, And so I just think that's like, anytime somebody tries to paint a picture like inflation is not going up, is like trying to, I won't say claim that it, do something and claim that it's raining.
Yeah. Yeah. And I, like, recently I heard on the public radio here, like, they were saying like, oh yeah, gasoline prices are going up. But what people don't realize is that, gasoline is only 4% of the consumer price index.
Yeah.
It's like, tell that to like, any blue coat worker or whoever needs to like gasoline to drive to work or something. Like, that's the cart before the horse. That's saying like, oh, but don't forget the propaganda says this should only account for 4% of your expenses. So yeah, I agree. Like, when they say disinflation, it's just it's just Fed speak for saying like, yes, it's still going up, albeit a little more slowly.
Yeah. The other thing to remember too is like whenever they quote these numbers, it's always compounded against the prior year. So like, hey, if in July of 2022 prices were up 9%, and then in 2023 they're up another 3%, that 12+% compounded of your money was destroyed over 2 years. So like the these ideas of like, well, inflation's going down, but it's like, well, now let's go back to 2020. Where are price levels today versus where they were 2020? Because this is a cumulative world.
No. We should uncork the champagne because the tumor has only grown by 3%.
Yeah.
and the 9% growth from the prior year is still there.
Yeah. Doesn't matter that it was already large enough to bankrupt you as it was. It's now just a little bit worse.
Yeah. Well, so let's go back to, I think, something that you guys mentioned very early on, which is the banking crisis, right? And this, I think, if I understand correctly, what happened was they bought a lot of treasuries when the interest rates were very low, and interest rates have gone up, which means that their bonds are worth less. So now they're kind of in a pickle unless they hold those treasuries to maturity, and they don't have liquidity in the meantime, something like that. And of course, like they can't afford to pay out larger interest rates to attract more capital. So they're kind of in this weird position. And this is, I guess, what caused the banks to shut down. Why isn't this happening more? And what's going on? Like, why are people keeping money in banks at this point?
Well, my very limited experience was just one conversation I remember from Bitcoin Miami, talking to a guy who was pretty high up in a regional bank. I forget which state it was. I think, it was Madison. So that's, where's that again? Wisconsin? Yeah, Wisconsin. Anyway, so he was saying that exactly the issue that you're talking about is literally being discussed among all the regional banks. Is like, ugh, like, why are people using us anymore? Like, there is higher risk, right? I mean, we suffer more greatly if there's a bank run. We're a lot more vulnerable to that. A lot of our old business isn't there anymore, like the mortgage stuff. Our assets are balance sheet is bloated with these mortgages that are really dangerous now. We don't write a lot of new loans. What about holding people's assets? Well, people don't park dollars with us anymore. And so he said in a survey, I believe it was 160 regional banks in the US indicated that, yes, they're very interested to move into managing crypto balances, because then they could retain some of those assets to then write out loans against or whatever they want to do. And legally speaking, they can't do that yet. So, but it's kind of, I think it speaks to the dire situation of these small time banks, that they're thinking of that as like, of all things to rescue them.
Yeah. And I also think that, I don't think that we have to be able to explain everything about human psychology, which is like, what I mean by that is the same question could have been asked of Bear Stearns and Lehman Brothers. You know, when Bear Stearns failed, Lehman Brothers was almost certainly at the same time insolvent. Like, why didn't it fail? You know, why didn't it just go Bear Stearns, Lehman, Washington Mutual, Goldman? Like, why didn't they all just happen in a matter of days? And that when everybody, you know, panics and hits the exit, like, why did they all panic at the same time? And then people get reassured that things are okay. Why'd they get reassured? They printed a lot of money and they said, hey, the Fed's in control. And there's some irrationality to that of like, well, if they were in control, why did a couple $200 billion banks evaporate functionally overnight, right? But the point is that the real underlying signal is that it hasn't gone away. So to think that the same issues that cause those banks to fail are not in the active process of causing others to fail, and that there's not going to be another wave, I think ignores the fundamentals and just pays attention to the psyop that's like, hey, there's a soft landing, there's disinflation. And so, yeah, I mean, it's like trying to explain exactly why the next bank failure didn't happen the next 2 days would like ignore the, you know, kind of human pattern of like, well, you know, people had their exit psychologically at the same time. And just because it's happening underneath the surface doesn't mean it's not still happening. And there's going to be another shoe to drop when things get tighter. Maybe it's the real estate market continuing to contract, or maybe it's, you know, something like that massive Chinese real estate company failing, causing people to be fearful again. You don't know, but nothing can escape the actual fundamentals, dollars and cents of massive leverage, less and less liquidity, and, you know, a next wave being set off.
Yeah, it's tempting to speculate. I've been thinking about like maybe Japan could be the canary in the coal mine. It's just like psychologically, like if we have an advanced Western economy that goes through a real inflationary crisis, you know, where they have to, who knows, like devalue, whatever it is, I think that could really set off alarm bells and people like, oh, this is not business as usual. Like this is not, oh, let's just paper it over and there's another bailout. Because people have this like mental dissonance where they look at like countries like Turkey and Argentina and they're like, oh yeah, but that's them, right? That's not us. As if the system is, you know, inherently different. It's not. It's just a matter of gradation and how far along they are. So yeah, and also I have been looking at Europe because, or I want to look at it more actually, but because historically Europe is just less united, is less glued together, has more discord within. You know, there's the northern countries who want to be more conservative, and then the southern ones, they really just want to keep spending, like Greece and Spain and such. And so every time it's, you know, the narrative is like, oh, everything's going wrong in the US, and then we see like giant crises happen in Europe, like 2011, 12. So I've been kind of like, I think a lot of the attention has been focused on the US, but I think there's some shoes that really could drop in, in Europe, like Deutsche Bank, for example, is terrible shape. And there's other examples and countries, of course, too.
And there's also a war going on in that continent.
Oh, I forgot. Yeah, right.
You would think that would affect things.
Yeah, and Brent, I don't know if you saw, but the European oil price, they have their own oil price, is I'm not saying it's breaking out, but it's broken above resistance. So there is a real chance that it could break up again, which would just really cause another energy crisis down there.
Yeah, and I think like just closing out, kind of the loop of like, and it's also part of the inspiration behind the Gradually and Suddenly. It was Hemingway's process of describing how people go bankrupt. It's like when Silicon Valley became insolvent was some time long before everybody else figured it out. So the same thing. It's like there's probably a bank that's clearly insolvent right now, and the people that have deposits there just don't know about it. And whenever they figure it out, the next wave of bank failures happens, right? Like where like the actual instance or like moment that bank has more liabilities than assets and it becomes clear is sometime before when the panic sets in and the majority of people figure out about it. It's like, hey, or like one analogy I like to use is like whenever a public company provides earnings, 45 days after a quarter or 60 days after a year ends, the market's responding to lagging information, right? Like it sells off on like the news that the company did fewer sales than they were expecting, but that actually happened in the past. They're just learning about it in the present. And the same thing is true. Like some event will happen and very few number of people will hear about it. They'll start acting.
So there's like an information propagation time that everything is delayed by.
Yeah.
I mean, I keep thinking about Margin Call, right? The movie Margin Call. It's Jeremy Irons is just such a brilliant movie. That's what I'm imagining when I hear Parker talk about these events where like internally they're like, holy shit, like we're basically going off the rails. We need to, I don't know, come out guns blazing or just try to extend and pretend. I think that, Margin Call, the movie, is happening, in various boardrooms and we'll find out about it at some point. Just like FTX collapsed, was insolvent way before we all found out, right?
Yeah.
And maybe similar with Binance. Who
Same
knows?
with Prime Trust, right? Like that court order, kind of alleged that they were probably insolvent as early as December 2021. And then that doesn't know for sure when it happened. Same thing with Celsius, right? So
yeah, and then you have to take into account that some of the way these numbers are calculated is also manipulatable. So you can mark to market and basically lie in your reporting and thereby keep up the charade for longer than a couple quarters. Yep.
Well, so let's talk about sort of the end game of all this, because I think what you guys are saying.
Make this like a 12-hour podcast.
we could. I'm not Lex Friedman though. But imagine that you do get a lot of these bank failures, right? And that's something that I think you guys are both saying is probably on the docket, right? Like there's a buzzsaw coming, and some of these banks are not going to survive. So the conspiracy theorist in me thinks that that's like the perfect setup for a CBDC, because you could get rid of all these banks and make the central bank everyone's bank. You have the technology. Everyone has an account with the central bank instead of your regional bank, all of which are insolvent anyway. And now you get a surveillance state. And, they maybe cast it as some form of compassion. The poorest people don't have checking accounts, and now they're going to get one through government intervention, and you're going to do it through a CBDC, branded some other way. But that seems to me the end game of this, and why they're not panicking over these bank failures. It seems like they're almost, the deep state seems to almost be cheering it on, which is a little bit weird. What do you guys think?
What do you think, Mark?
I mean, just looking at Jerome Powell speak, Janet Yellen speak, like these do not come across as confident people. So I think to say that I believe that people in the Fed are scared shitless, and I believe people at Treasury are scared shitless. That they don't have all the answers. That it is a scenario where the emperor has no clothes, and with passing days, it becomes more obvious, and they need people to have confidence in them. And so I don't think that you're necessarily wrong, that there isn't somebody sitting there saying, hey, this would be a lot easier to plug all the holes in the leaky ship if we had a CBDC, right? There are certainly people who are thinking that. Now, I will reinforce, even though that a lot of these things that these people do is crazy, that, you know, they still have to follow the law. They just bend it in ways from time to time where, like, as an example, when the Fed printed $5 trillion in the 2020 to 2022 period, really 2019, technically the Fed cannot lend directly to corporate entities. So they had to create without changing the charter, which has to be approved by Congress, they figured out a route around where basically they financed the Treasury put the equity in that the Fed gave them, and then the Fed lent to the Treasury 90%. So, and then the Treasury was the one who was buying the equity in the corporate bonds. So that was an example where, like, the Fed wanted to just go buy corporate bonds, but they needed to create a legal structure that probably wouldn't hold up in court, but that they could at least point to and say, we operated within our charter. Even if common sense might say we bent the rules and possibly even broke them, you know, at least there's some, you know, red tape that said we did it right. The context of the CBDC basically taking out the banks and lending directly. Problem is that becomes more overt. Like, we actually have to change the charter. So at the same time that there's people out with pitchforks with inflation saying this entity is causing all these problems, I think it would be very hard, at least in the United States, to get that done. Not to say that I think the conspiracy theorist in you is right, that like somewhere Paul Krugman is sitting there, or a Stephanie Kelton, these monetarist Keynesian, you know, modern monetary theorists saying this would be a lot easier. I think the bottom line though is, and it's the problem that the Fed has today, they're always reactive. So imagine like a ship breaking at the seams. You can put the money in, but you can't make it go where you need it to go for it. You basically have one shot. Now you can take more shots, but once you put the money in the system, you can't make it go where you need it to. You can only do that once, and you can do it over and over by printing more money, but it's still, you can't, like, once it's in the system, you can't inject it, you know, in different parts. And so a CBDC would have the same problem as the current construct. And so I think that it's like, one, for legal reasons, they probably can't do it, at least not here in the United States. Two, it would suffer from the same fundamental problem of, like, you can put money in the ship, but you can't make it go where you want to go once it's there once. And in this instance, the banks and the Fed are mutually assured destruction. If the banks become at odds with the Fed, then they both die faster than if they're cooperating with each other, because their cooperation with each other, like, the Fed needs the banks to continue its charade, and the banks need the Fed for the same reason. So I think it's like mutually assured destruction if the Fed becomes competitive to the JP Morgans of the world or the other mega banks. Like,
I agree. Yeah, I don't think they can handle it alone. And I agree with what you said about that. You know, central banks are panicking and they kind of don't know what they're doing. There's this one quote which to me was one of the most telling of the last few years. Kristalina Georgieva, she's like really high up in the IMF, and she was on a panel with Christine Lagarde, and she literally said that, like, you know, what central bankers, the way they pursue their policy is a bit like 8-year-olds playing soccer. Like, they, you know, there's like the ball is there and they just all run for the ball and they're just complete chaos basically. And the ball, the symbol there is like whatever event happens to be in the news as like so they're very much trying to manage perception much more than having a big picture plan. I do think there is kind of an evolution that is very likely, which you don't have to be just a conspiracy theorist. You can just look at policy that was produced by the FSB, Financial Stability Board, and the Bank for International Settlements going back to 2011, where they were like, okay, we had this financial crisis. Clearly, a lot of banks are very, not up to snuff with their finances, and they were basically admitting, like, this is going to happen again. Like, we're going to have more of these crises, so we need to figure out which banks we're going to bail out and which banks are going to get the bail-in, which is basically saying all the depositors get a haircut, just like Cyprus style. And we're not going to push in money from outside to rescue them. We're just going to say there's only so much money. So there you go, 30 cents on the dollar. Bye-bye. And the shareholders lose all the value. So then they had to figure out how to make that distinction. They came up with this concept called systemically important financial institution, SIFI, sci-fi, and then also G, sci-fi, globally systemically important financial institutions. So you can actually look up that list. Like, it's just literally a list of banks, and they update it every now and then. And that's my best bet, is like, those banks, and it's very U.S. heavy, United States heavy, are likely going to be the banks that are going to keep existing. And a lot of the other banks can fall away. And so if we're going to go into, more pushing towards something like a CBDC, which to me is just, I don't know, it's just more propaganda than anything. Because what are you going to put it on a blockchain? Like, it doesn't really matter. I do think they might want to control it more, have more quote unquote transparency. But so, yeah, rather than the Fed ever interacting with consumers directly, like, they can't do that. They don't have the technical ability. They don't have they need a marketing arm. They need different banks to compete with each other. So I don't know, I can see a future where we just have less banks, right? Where we have like a kind of what Marx envisioned, right? A centralized system with a few banks that are practically owned by the government. And that would be Krugman's wet dream, but it would also be just an inflationary environment where pretty much everyone would just want to own Bitcoin and just not deal with that stuff.
Well, so I'm reminded of what happened with the 2008 crisis, because essentially that's what brought in Obamacare, right? The quote back then was, "Don't ever let a crisis go to waste." They used the crisis to essentially push through an agenda item that their party has been wanting for something like 50 years at that point. And it seems like if you do have a banking crisis, this is one of those crises that you can't afford to let go waste if you are in power. And they seem to be going in that direction. And, I don't think the government is very good at doing healthcare either, but they've managed to sort of co-opt a lot of private health insurers into their orbit somehow through legislation, and essentially made them part of the bureaucratic state. Seems like they're halfway there with banks already. I mean, like, is that so far from a CBDC?
Yeah, I mean, I think that the Fed is owned by the banks, right? It's like federally chartered, and there's, government approvals for certain appointments. And so it's a quasi, even though it is technically a private institution, it's quasi-public. But the large financial institutions are the primary stakeholders, right? JP Morgan, Goldman Sachs, Bank of America. So I think that's also one of the reasons why what Tuur was saying was that, like, they have this system, they already exert a lot of control and power through it, to think that the continued path, incremental path down is not the more path of least resistance, and the one that allows their system to stay in place is the more the thing that is most logical probably happens. So it's like, yes, they do functionally get the outcomes and control that they want, and if they can continue to consolidate, they do that. The private sector becomes to look more and more like a publicly controlled sector, the fewer and fewer entities there are. But it is also the most logical. It's already been happening. It's the most logical thing to continue to happen based on the structure of the system. So, Goldman Sachs and Bank of America and extensions, JP Morgan, extensions of the Fed, which is an extension of the state. So, yes, like the banking system hasn't been technically nationalized, but I think functionally the federal government has sufficient control over it that in times of great crisis, the two can be looked at as unified, at least in purpose.
Well, so let's talk about sort of the more practical prepping, if you will, for those of the audience that are listening or watching. What would you suggest to prepare for sort of like the coming buzzsaw, as you put it? What do you do? I mean, I guess you could buy Bitcoin, but certainly there are other sort of knock-on effects that you could probably logically reason out. What are some of those things?
It's hard. It's really hard because, I've just always tried to look at places, like I said, like Latin America and places like that, is like, how do people deal with the situation there? And what you want when that comes, that, storm or wildfire, whatever you want to call it, is optionality. Like that is really the thing that's so valuable, because you don't know exactly how it plays out. All right. You don't know which bubble pops first. And then it was similar to the mania of 2021. It's like, how do you position for that? Should you have bought a Rolex beforehand? You didn't know that it was going to be a Rolex that was going to. So I think similarly, when things melt down, you can't necessarily know when the bottom comes and in what asset, or also maybe even like where to live. Like, is your neighborhood going to be the one that turns into a crime-ridden zone, or is yours going to be the one? Maybe, a proxy is like, if you live where the doctors and the lawyers live, like maybe that's going to kind of still, generally speaking, for real estate, what I've gleaned from like places like Argentina is that when there's a devaluation event or something like that, or a big boost in inflation, the real estate values close to the city centers tend to remain more intact. Like even 2001 Corralito, I believe Buenos Aires, the wealthier neighborhoods only lost like 25% at the bottom, whereas other parts of the country would go down, like I believe like 50% in dollar terms. So yeah, it's very, very hard. There's people who say like, oh yeah, lever up and get a big mortgage, a 30-year mortgage, and then and then
at 8%, yeah.
Well, yeah, but this is kind of like, yeah, but then you're tied up in an illiquid asset, and there's so much around that's unpredictable. I feel hesitant to actually recommend something like that. Whereas with Bitcoin, no matter what, you will have optionality. So it's hard for me to look much beyond. If I have no idea who my audience is, and it's not a one-on-one conversation, to make many more suggestions. And yeah, buy Bitcoin, maybe some gold, just assets that have high scarcity, lower third party risk, and high liquidity.
Yeah, I think that I'd agree with all of that. I think one is just preparing like psychologically without being pessimistic, like to basically be like, hey, if you read history, I think everybody has this perspective of things always getting better, and that's just not
Whig history. Yeah,
that's not the way the world works. That things can get worse, and that wealth can be destroyed when currencies hyperinflate. Wealth is destroyed, and when quote wealth is destroyed at a societal level, that means that life might just get more difficult. In aggregate for everybody, and some people might do better or worse in that world, but that we're in a period where, we've got to take some pain, and to be okay without having to like go to like the doom and gloom of like, well, this shoe's going to drop and then that's going to drop and I'm going to go get in a hole and not be able to act. It's just being like, okay, in like whatever comes in discomfort. And while it's actually the case that, things do get worse for periods of time, and that's perfectly normal with history, that humans also survive, and weather the storm. And so if you're just trying to think about it financially, it's not the right way to think about it. It's like, okay, I need to be prepared, but I don't need to be afraid of my own shadow and constantly looking behind me. I've got to be able to put one foot in front of the other. And so I think that part of it is having Bitcoin. Obviously, that's the way the world's going. I think hearing stories that you've shared of traveling the world and experiencing these places with hyperinflation, well, as disastrous as that is, by having access to a form of money that's working, things don't just devolve into the Stone Age, and that Bitcoin is a form of money that we all know works. And so whatever pain is going to have to be felt, it's not necessarily like the financial gain that we will get whenever the world figures out that they all need Bitcoin. It's that the trade routes will be far more resilient than they otherwise would be if Bitcoin didn't exist. Like our abilities to coordinate trade, having a form of money that's working throughout this is why there's such a great source of optimism. And then it's like, figure out a skill that you think on the other side of that horizon people are actually going to need, right? Because if you're a banker sitting in one of these financial institutions and that is your skill and that's the thing that puts food on the table for you, like that's probably not going to be there. Like if you're somebody that's a social media influencer, like maybe not gonna, but also I like one recommendation is like get a good friend like Cole Bolton across across town that sells beef for Bitcoin, or like make good friends with a guy who knows how to get oil and gas out of the ground, like figure out the things that are
go learn welding,
like figure out how to weld, like learn how to, like, I don't know, that the things that if you were to say, maybe a good exercise is like, if I was to cut out 5 things and then go through the exercise of what are the 5 things I couldn't cut out. That's a generally good exercise to figure out like what really matters and what's important. And, start to question is like, hey, a lot of people mine fiat, like go to their day job. That they know is just a fiat existence. And that they probably know that on a Bitcoin standard isn't going to be there. It's like, well, maybe get off that trap and, start to deliver value to the new world.
Yeah, I agree with almost all that, or probably all that. And one thing that I've seen sometimes people get stuck in is like this idea, like, but people don't understand and kind of like having a fear for everyone is going to lose their mind once the crisis is here. And in a way that we need to warn everyone or talk loudly about this so that the world is kind of prepared. I think that's not a very productive use of like your resources and your time. I think we've seen with the COVID crisis that even people who were in denial about it a week beforehand or whatever, they just adjusted very quickly. Like, and you see the same in all kinds of countries that go through financial crises. The adjustment, that's why we're human. Like we are so adaptable. We just adjust to the new situation. And so rather than like trying to, I don't know, kind of shake the world and move the world, which you by definition cannot do, I would suggest like just sweep in front of your own front yard and or your own house and just make the preparations that you think you'll do. And it's almost like, because the whole world is already insolvent or your country is already insolvent, the only thing you could do by quote unquote warning as many people as possible is just make the crisis happen a little faster. Like that's, there's only so many lifeboats and a lot of people are going to lose their shirt. It's baked into the cake already, right? We can't escape that. So yeah, I do think that, focusing on your own skills is a big one too. I like that a lot. And try to have quality people and that you hang out with and that maybe later you'll work with. Yeah.
So stoicism, self-sufficiency, self-sovereignty, that seem to be very aligned with Bitcoin. So very, very fun and interesting conversation. Thank you guys both for the conversation. Anything that you guys are working on or anything that my audience could benefit from?
Yes, but I can't talk about it yet. I mean, I am really excited just about, because I feel like we're talking about the crisis, but like just to keep in mind, like what's what's out there potentially, you know, like a revival of, I mean, we were talking about some of the art that's collected in the Vatican and, you know, all these like times of the Renaissance and things like that. Like people forget, like those were chaotic times. Like those were not like, oh, everything is great and everyone's happy. Like, you know, and so I think that, you know, some of the amazing things that are going to happen, we will see, like, you know, even during some of these crises, we'll see, you know, just incredible feats of courage, of beauty, and that excites me. Like, we don't have to wait for the promised land and, you know, maybe it'll be only my children. Like, I feel really happy and kind of privileged that I can, you know, be here and kind of see this incredible transition. And yeah, I mean, we need some creative destruction. Like we need the economy to shift entirely. So yeah, there's going to be pain, but on the other hand, I so love that I live in this period where we're crawling out of denial rather than having to live in like peak fiat where there just seems to be nothing else.
Yeah. Amen to that, you know? Well, one, I'm interested in what Tuur's working on next. So we'll have to pry once we get off the air. So I'm in the process of finalizing my book. Luckily had you as an accountability partner. You got yours to market a little bit before me, but going to be launching a crowdfund, probably, but before this podcast comes out, depending on how quickly you get it out there. But that book will be an adaptation of the series that I wrote from 2019 to 2020 called Gradually Then Suddenly. Print version should be ready by October, but the crowdfund will start this week. And then also started contributing to Zaprite, which is a company that helps businesses accept Bitcoin payments and providing accounting tools to make that process and the shift to a Bitcoin standard more seamless, specifically focused on business invoicing as well as e-commerce and payment links. So check that out, zaprite.com, Z-A-P-R-I-T-E. So the right is R-I-T-E. If you want to start to accept Bitcoin payments, the idea is we enable people to receive Bitcoin payments non-custodially, but we host the server, so you don't have to.
Okay, great. Well, thank you guys both, and yeah, excited to get this podcast out.
Thanks, Jimmy.
Unchained Capital is a sponsor of this podcast. I'm an advisor to the company. I know the team well, and I'm excited for what they are building. If you need multi-sig, collaborative custody, or a Bitcoin native financial services partner, learn more at unchained.com.